Look, if you trade crypto, you've surely faced these situations. Stop losses get hit, then the price bounces right back, or a huge wall in the order book vanishes a second before a breakout, or a fresh token backed by influencers with wild growth potential drops 60% in the first month without a single piece of bad news. Traders are used to blaming such stories on volatility, weak hands, or just bad timing. But in reality, many of these situations are the work of 7 companies that control about 80% of the crypto market's liquidity. Their business model is designed so that you're bound to lose, and lose consistently. In this video, you'll learn how the market maker's business model works. From now on, we'll call them MMs. 7 main techniques for scamming traders, several real cases, and the scale of market makers' capabilities, as well as 4 survival rules for the retail trader. Let's go. A market maker is a company that simultaneously places buy and sell orders for an asset and profits from the spread, that is, the difference between the buy and sell price. In the stock market, these are dozens of regulated firms with obligations to provide liquidity. In crypto, it's different. There's almost nothing to regulate, almost no obligations, and just 7 companies control most of the pricing. And here is the list. They are Wintermute, Jump Crypto, GSR Markets, Cumberland, B2C2, Galaxy Digital Trading, and DWF Labs. However, the main income for such companies is a model known in the industry as a loan plus call option. It works like this. A young project, for example, a new L2 or DeFi protocol, wants to list on an exchange and get liquidity. The market maker says, lend me 5 to 8% of all your tokens for 12 or 24 months. I'll provide liquidity, listings, and volume, and in exchange, I'll get a call option, the right to buy back these tokens at the end of the contract at a prefixed price, say the listing price, or with a small premium. Why does the market maker do this? The MM gets, let's say, 5 million tokens as a loan. The price at the time of the coin's listing is $1, and the option allows them to buy it back at 1.2. What's more profitable for you as a market maker, for the price to rise to $2 or for it to drop to 20 cents? The answer is paradoxical. It's better if the price drops because you can first sell those 5 million tokens at the peak right after listing and get 5 million and then buy them back cheaper and return them to the project. The difference between selling at listing and buying back at the bottom is your profit. The more the token has dropped, the more you've earned. You might not use the option at all, but it's critically important as insurance. Without it, any attempt to crash the price is a huge risk. If the market turns upward, the market maker will have to buy the token back from the market at a higher price than they sold it for. The option removes this risk. If the price went down, you earned on the difference between the sale and the subsequent buyback. If the price went up, you earned on the option. In the end, the market maker has a win-win situation. The company makes money either way, and this isn't a market bug, it's its business model. Every time you buy a fresh layer, 2 token 2 weeks after listing, and wonder why it's constantly dumping, the answer lies in the market maker's interest, not because nobody wants it. It's just that the market maker systematically sells while they hold a protective option. Chainalysis noted in its report for 2025 that over 2 million tokens were launched in 2024. Of those, only about 1.7% are actively traded. The rest is deadweight or fraud. And according to estimates by Evan Coleman from the investigative firm Cloudburst Technologies, $120 billion a year is drained from crypto through pump and dump schemes. We're dealing with a system and it's working against us. Well, okay, we figured out the motive. But how exactly do market makers go about their business so that you don't even notice it? Next, I'll tell you about 7 key techniques, each of which leaves its mark in the order book. First, wash trading or fictitious trading. A bot buys from itself through dummy wallets. The volume in the order book grows and the metric 24-hour trading volume skyrockets. The token hits the top by trading volume on aggregators, attracting real buyers. In the latest NBER study for 2022, a figure of 70% is cited. That's exactly how much of the trading volume on unregulated crypto exchanges is fake. When you see a volume of 200 million in a day, the real volume might be somewhere around 2 to 3 times less. Everything else is not real trading. Second, spoofing or fake orders. A bot places a large limit order, for example, a sale for $20 million just above the current price. This wall in the order book is visible to everyone. Traders react to it, sell from the wall, and set stops behind it. The price drops, and just before the price at which this large order is placed is reached, it's simply cancelled, and the price skyrockets. Everyone who was selling takes a loss. Bots can create thousands of such orders in just a couple of seconds. In the stock market, you can go to jail for this, but in crypto, it's a common industry practice. Third, stop-loss hunting or hunting for stops. The most painful thing for a retail trader. Market makers know where stops statistically cluster. At round levels, below local minimums, below weekly lows. On weekends and at night, liquidity at, the best quotes can drop by 90% or more. This means that to move the price by, say, $500, you need 10 times less money than on a work day. A bot can place a large sell order that will pierce some current level. Stops below the price are triggered in a cascade. The price goes down. In the sell-off that appeared out of nowhere, the robot builds a position in the opposite direction, buying the asset cheaper. After a couple of hours, the price returns to the level it was at before the sell-off. Traders were knocked out of their trades, the market maker made a profit. This is called a sweep or liquidity clearing, and it happens dozens of times a week on liquid pairs. Fourth, quote stuffing or order overloading. A bot floods the exchange with hundreds of thousands of orders and cancellations per second. The goal is to prevent competing algorithms from analyzing the situation and to stop human traders from buying or selling anything at all. While competing robots are stalling and traders are experiencing lag, the market maker's bot manages to catch arbitrage trades between the current exchange and another one. In reality, it's not the exchange lagging. The entire bandwidth is simply overloaded by a robot doing it on purpose. This manipulation is often carried out by large market makers on servers located in the same data center as the exchange's servers, using dedicated channels sold to them by that very exchange. An individual trader's equipment physically cannot withstand this. Fifth, painting the tape, or tape painting. Coordinated trades on different exchanges allow for drawing a beautiful trend picture or a typical price pattern like Head and Shoulders. The pattern is drawn perfectly. Technical indicators give buy signals. Real buyers are drawn into the coin, and at the right moment, the robot closes the position against everyone. An unfulfilled Head and Shoulders pattern remains on the chart. Traders are in the red. The market maker has profited, thus technical analysis so loved by traders becomes a basis for manipulation. And the more popular technical analysis is with retail, the more profitable it is for a market maker to draw a recognizable pattern. Number 6, gamma hedging cascades or a gamma cascade. A situation that in January and February of 2026 dropped Bitcoin from $125,000 to $60,000. I talked about this scheme in detail in a separate video. I'll put it simply here. Such a situation means that when the price falls below a certain level, the market maker is forced to sell the underlying asset, in our case Bitcoin, to reduce their risks. Each such sell pushes the price even lower and forces the MM to sell even more. No conspiracies here. Quite standard behavior for a major player cutting their risk. But because all the major players are doing the same thing, single sales turn into a flood of selling, and the market can't take it. Number 7, front running. Literally, it's running ahead, meaning placing trades knowing in advance that someone else's order will drive up the price. The manipulation is based on insider info as old as time. In the stock market, this is a criminal offense. In crypto, front running has reached truly epic proportions due to its simplicity. The form preferred by market makers is called classic front running on the OTC market. Suppose a large fund comes to a market maker and says, "We need to buy Sol for $50 million over the next 2 hours." The MM accepts the order and first builds a position for themselves. On the public market, the price rises by 1.5% due to the purchase, and then the MM executes the client's order at this new, better price. The 1.5% difference on 50 million is $750,000 in profit for the market maker, thanks to their own client. The 7 techniques listed above are the main ones. Now let's look at specific cases of abuse, and there have been quite a few of them over the last couple of years. Operation Token Mirrors by the FBI and the US Department of Justice in 2024. The most high-profile operation to uncover crypto scammers in history. The FBI created its own fake crypto company with a fake token, NextFund AI, and began waiting for offers from market makers. And they came. Gotbit, ZMQuant, CLS Global, and MyTrade fell for the bait. 18 people were charged with fraud, the most famous of whom is Alexei Andreyunin, CEO of Gotbit. On-chain analysis by investigators has shown that, for instance, 99% of Gotbit's transactions are circular, meaning the market maker's bot mostly trades with itself and drives the price back and forth. FBI agents even managed to record the head of Gotbit explicitly describing his wash trading methods in plain words. As a result of the case, over $25 million in crypto was seized. After these initial successes, the FBI didn't stop there. In the second round, back in 2025 and 2026, several more fake tokens were launched, expecting the same reaction from market makers. And it didn't take long to happen. By September 2025, indictments were ready against employees of 4 more companies. And those are Gotbit, Vortex, Antier Solutions, and Contrarian once again. This time 2 more CEOs were caught. They are Gleb Gora from Vortex and Manu Singh from Contrarian. Following the operation, the Department of Justice confirmed that the fraudulent trading industry didn't shut down after the first wave of arrests in 2024. Market makers simply became more cautious. In that same year, 2024, Binance conducted an internal investigation into market maker DWF Labs, one of its largest clients in the VIP segment. As a result, $300 million were found to be involved in wash trading on the YGG token and 6 others. What do you think Binance did? Binance fired its own investigators. DWF remained a client, and a follow-up investigation failed to find sufficient evidence. And Wintermute apparently decided to push its competitor out of the market. It publicly accused DWF of fraud, claiming the company passes off OTC trades with dump potential as investments. DWF denied everything. Naturally, no criminal case was opened. The company continues to work with dozens of top-tier projects. According to their own statements, they provide liquidity for up to 25% of projects in the top 100 cryptocurrencies. Specific coins aren't mentioned, but I've brought their public portfolio for you. It's in the link below the video. Speaking of Wintermute, which so zealously rushed to defend integrity, in April 2025, the company made a good profit on the FDUSD token. This stablecoin depegged from the dollar and dropped in price to 87 cents after Justin Sun publicly called the issuer insolvent. Wintermute bought up the stablecoin at 90 cents and directly exchanged the token for dollars at $1 each with First Digital. Such deals are only available to large stablecoin holders on the whitelist, access to which costs a significant amount of money. 10% profit a day on arbitrage is a pretty good deal, earning the company $3 million in just 24 hours. Yes, technically it's not manipulation, but it's a perfect example of how much more power market makers have compared to retail traders. And here's another very recent example to help understand the difference in the scale of opportunities. On April 7th, peace talks regarding Iran fell through. Bitcoin had previously jumped above $70,000 on hopes of a truce. After the talks failed, Wintermute began aggressively moving Bitcoin to exchanges specifically during low liquidity hours. Bit by bit to various platforms from Binance to Robinhood. This breakdown is a typical strategy to spread out selling pressure and prevent the market from seeing a large sale. Bitcoin dropped to $60,950. Bitfinex issued a warning that below 68,000, a cascade of sales could begin to hedge option positions. The target level for Bitcoin's drop was 60,000. Ultimately, the price stopped at 67,700. Not Wintermute's most successful trade, but what's important here is the connection on which decisions were based. Geopolitical news and expectations, lack of liquidity in exchange order books, and a potential liquidity cascade down to 60,000. This is one of the best documented examples of market makers synchronizing their moves with political events, choosing the exact time when a retail trader has the least chance to react. As we can see, both large and small market makers don't hesitate to use their advantages. And now we'll move on to the question, why does the average crypto trader always lose in this system? To start, 5 reasons why a retail trader in crypto is in a losing position by default. First is speed. A bot reacts in milliseconds. A human needs time to make a decision. A minute passes between your decision to buy and your click. In that minute, the bot has already seen the move, bought in, knowing you'll enter the trade, and placed a limit order in the book, preparing to sell to you at the best price. Capital. Market makers have billions of dollars in working capital, while a retail trader has a few thousand at best. They can move the price, you can only react. Information. A market maker knows which projects are planning a listing, which funds will be buying, and what over-the-counter deal is being prepared. A trader gets information with a delay, sometimes by days or even hours. Infrastructure. servers are in the same data centers as the exchange servers. You have a browser on a laptop running through Wi-Fi. The latency difference is tens of milliseconds, and that's enough to snatch any arbitrage before the trader. Regulations. In the stock market, the system of mechanics from the previous block is a crime. In the crypto market, 6 of them are a gray area or not regulated at all. The first attempt at regulation is the European MiCA. This package of laws provides for fines of up to 15 million euros or 15% of annual turnover for unfair practices. But so far it works just so-so. And in the US, there isn't a single legal act yet that would regulate the activities of market makers. Okay, so what should an ordinary trader do to somehow resist this juggernaut? Here are 4 rules that won't make you equal to a market maker, but will reduce some of the risks. First, horizon. This is your only real advantage. Bots trade in minutes and seconds. Their domain is short intervals. If you hold Bitcoin for 5 years, then endless nightly stop-loss spikes, wall levels in the order book effectively cease to exist for you. You're outside the MM's zone of interest. Second, don't trade at night or on weekends. Liquidity in the order books can drop by up to 90%. All controversial trades of your crypto career will likely fall during the night or on weekends. Third, avoid fresh listings in the first, 90-60 days. This is a time window when the main model, debt plus call option, works at its peak. The mem can lower the price to buy back tokens cheaper and return the debt to the project. The vast majority of charts for a new token's first month of life are almost always a parabolic drop. Fourth, don't trust the order book and volume. The volume you see might be fake. Huge walls in the order books, disappearing levels, and sudden breakouts when you expect a pullback, that's the MM's bread and butter. It's extremely dangerous to build trading strategies around a strong support level visible through volume. There's a chance it's being painted for you. And one last point before we finish. A market maker isn't a villain by default. It's a business with a transparent model where the retail trader is neither a client nor an opponent, but raw material. People like to compare crypto to the Wild West. It's a flawed metaphor. In the Wild West, both cowboys had a revolver and a chance to draw it faster. In crypto, you have a water gun while your opponent has a machine gun. Your chances are slim if you don't follow certain rules. Long-term spot trades or low leverage automatically exclude you from the MM's sphere of interest. Trading on 5-minute charts is a situation where every move in the order book works against you. And most importantly, the fact that you now know how it all works is already an advantage. Most of your colleagues don't know. They continue to blame their losses on bad timing. You don't. So, like this video if it was helpful, subscribe to the channel and hit the bell. Ciao!